Hello everyone! My name is Jin. I'm a full-time mom and a property investor in the UK. I specialize in family lets in the northeast of England. In this video, I want to share with you how to be tax efficient in property investing while being in the UK. As property investors, we want to be serious about three types of tax: income tax, capital gains tax, and inheritance tax. Before we crack on with any of those, there are two important rules to be tax efficient in property investing, so please write them down. Number one, never sell your investment properties. And number two, as the property value goes up, increase the debt against it. Now, these two rules come about because of how taxes work in the UK, so you need to understand all three taxes to be tax efficient. I'll be explaining these in three separate videos, so make sure that you stay tuned to this three-part mini-series. Okay, so let's look at capital gains tax. Let's imagine we have two identical people, Sam and Kim. They are identical in every way. Same job, same income for the next 15 years, same age, and they buy identical houses right next to each other for £100,000 each. On average, house values double in value every 8 years in the UK. But let's be conservative and say it takes 15 years in order to double. In 15 years' time, the house Sam and Kim bought will be worth £200,000. And in another 15 years' time, it will be worth £400,000. Sam does not sell his house, but Kim does. When Kim sells her house after 30 years, the government tells her she needs to pay capital gains tax upon the sale. She's a 40% income taxpayer, and therefore she needs to pay 28% of capital gains tax. That's £84,000 of capital gains tax that Kim needs to pay. She's selling the house for £400,000. She then pays her tax bill, pays the estate agent, the solicitor, and she's left with £300,000. Now, Sam heard me say to not ever sell property investment, and he decides to remortgage. He borrows at 75% of the new value of £400,000, and therefore that's £300,000 that Sam borrows from the bank. So now Kim and Sam both have £300,000 in the bank account. The difference is, though, that Kim no longer owns a house while Sam does. And what's going to happen in 15 years' time? Sam still has a house that would have doubled in value again and would now be worth £800,000. And in the next 15 years, that house will be worth £1.6 million. So Kim is missing out on £1.2 million of growth simply because she sold her house. So never ever sell your property investments. Take it to the grave. Die owning your property. Upon my death, the capital gains tax on my property investments will get written off. No one has to pay for it. I will tell you a little bit more about inheritance tax in my next video, but remember that there will be no capital gains tax to pay. So I hope you enjoyed this video and learned something new. If you're looking to start your property investment journey, or you have some money but no time and experience, please feel free to reach out and I'll be more than happy to see how I can help. With that, I'll see you in my next video. Thank you. Goodbye.